Good evening. We begin tonight with a story that has sent shockwaves through one of New York City's most iconic commercial corridors. This week, the precious metals market experienced turbulence of historic proportions, and nowhere was that chaos more visible than along West 47th Street in Manhattan, a stretch of pavement known to traders and tourists alike as the Diamond District. Silver and gold, two commodities traditionally viewed as stable stores of value during uncertain times, underwent price swings so severe that dealers who have worked in the industry for decades found themselves unable to conduct routine business. The volatility was not a slow burn. It was sudden, sharp, and relentless. The events unfolded over the course of just a few days, beginning midweek and escalating rapidly into what can only be described as market pandemonium. By Thursday at noon, the sidewalks were crowded, the telephones inside the shops were ringing without pause, and dealers were standing in front of their inventory with expressions that betrayed confusion and concern. These are professionals who price metal for a living. They work with scales, screens, and spreadsheets. They know the market. Yet on this particular day, they could not confidently tell customers what their gold or silver was worth. The numbers on their computer monitors were changing too quickly. The usual methods of valuation had broken down. To understand what happened, it is necessary to step back and examine the broader trend that preceded this week's chaos. Silver and gold had not been static in recent months. Both metals had been climbing steadily in value, responding to a variety of economic signals that made investors nervous about the stability of traditional currencies. Inflation concerns persisted. Geopolitical tensions remained elevated. Policy announcements from Washington added layers of uncertainty to an already jittery marketplace. These factors combined to create an environment in which precious metals became increasingly attractive. Buyers were not simply collectors or hobbyists. They were individuals and institutions seeking protection against what they perceived as growing financial risk. The rally continued through the winter. Prices rose week after week. Then, late Wednesday, the rally reached a crescendo. Silver and gold both hit record highs. The gains on that single day were enormous. Traders who had been watching the climb with cautious optimism suddenly found themselves holding assets that had appreciated faster than almost anyone had anticipated. For a brief moment, it seemed as though the upward momentum might continue unchecked. That moment did not last. Early Thursday morning, the market reversed course with stunning speed. Within the span of approximately 30 minutes, both silver and gold fell close to 10%. This was not a gradual decline. It was a freefall. The kind of movement that triggers alarms on trading desks and sends analysts scrambling to identify the cause. For dealers in the Diamond District, the impact was immediate and personal. They had purchased metal at elevated prices. They had committed cash. Now, the value of that inventory was plummeting in real time, and there was no clear indication of where the bottom might be. By Thursday afternoon, prices had rebounded somewhat. The recovery offered a glimmer of hope that perhaps the worst had passed, that the morning's sell-off had been an overreaction, and that the market might stabilize. That hope proved to be short-lived. The calm that returned in the afternoon did not hold. On Friday, the turbulence resumed with even greater force. President Donald Trump announced his selection of Kevin Warsh as the next chair of the Federal Reserve. The announcement sent ripples through financial markets. Silver, in particular, reacted violently. The metal fell more than 25% in a single day. It was the largest one-day drop ever recorded for silver. The decline was unprecedented in both speed and magnitude. For the dealers working along West 47th Street, Friday's collapse transformed an already difficult situation into something far worse. These are businesses that operate on thin profit margins. They buy metal, they sell metal, and they make money on the spread between those two transactions. When prices are stable, the model works. When prices swing wildly within hours, the model breaks. The risk of holding inventory becomes unacceptable. Cash flow tightens. Decisions that would normally be routine become fraught with danger. One dealer, who identified himself only as Moses and who operates a store called Moses the Jeweler, described the scene at the refineries on Thursday. He stated that he had gone to sell gold and encountered what he characterized as pandemonium. The individuals who melt down metal and convert it into tradable form were overwhelmed. According to Moses, prices had gone ballistic. The refineries had run out of physical cash. They had purchased too much metal in the preceding days. And now, as panic selling set in, they were unable to continue buying. The flow of transactions, which is the lifeblood of the industry, had been disrupted. Moses declined to provide his full name, a choice that was common among the people interviewed on the block. He was dressed in layers of jewelry and stood inside his sleek storefront with several young men who were similarly adorned. His account was consistent with reports from others in the area. The last week had fundamentally altered the nature of precious metals trading. Assets that are typically thought of as safe havens, reliable stores of value that investors turn to in times of crisis, had become short-term speculative bets. The shift happened quickly, and it caught many participants off guard. Investors of all sizes had piled into silver and gold in recent months. The motivation was clear. Inflation worries remained a constant presence in the economic conversation. Trump's policy decisions, ranging from trade to fiscal matters, had shaken confidence in the stability of the dollar. When confidence in a currency weakens, demand for tangible assets like precious metals tends to rise. That dynamic fueled the rally. It also fed the wild price changes that followed. For dealers working on razor-thin margins, the wild swings introduced immediate and severe risk. On Thursday, at least 3 large refineries located on Jewelers Row made the decision to stop buying metal from sellers. This was not a minor inconvenience. It was a fundamental disruption to the market. When refineries stop buying, the chain breaks. Individuals and businesses that need to sell metal have nowhere to turn. Prices become meaningless because there is no transaction to validate them. The freeze was not theoretical, it was real, and it affected operations up and down the street. Mickey, who has worked at a store called Paralyzes NYC for 6 years, confirmed the situation. He described the development as super recent, occurring specifically within the current week. According to Mickey, a lot of places were not buying because they were afraid they would take in gold or silver at a high price and then watch the market dip shortly afterward. The same concern applied to silver. He explained that refineries depend on volume. They process large quantities of metal and make money through the aggregate of many small transactions. A drop of around 10% in one morning, which is exactly what happened on Thursday, can eliminate profits entirely. When that risk becomes real, the safest choice is to stop buying until the market stabilizes. The freeze was not confined to the refineries and the larger dealers. It reached the street level. 3 17-year-old individuals attempted to sell 3 silver coins that were 90% pure. They asked for $250 total. Nobody wanted to buy them. One of the teenagers, who gave his name as Andrew, said he had found the coins in a jar at home and thought it might be a good time to sell. He and his companions had no luck. According to Andrew, it was not the right time in the market. No one was refining silver. His experience was a microcosm of the broader paralysis that had gripped the district. Inside a business called Modern Exchange, the atmosphere was thick with the smell of solder, a scent familiar to anyone who has spent time in jewelry shops where metal is worked and repaired. A man named Alex said he was carrying $10,000 in cash with the intention of buying gold coins. His reasoning was straightforward. He wanted protection against what he viewed as Trump's plan to weaken the dollar. Alex explained that for 20 or 30 years, the United States had been buying from China and adding debt. If the dollar weakens and gold rises, he said, the metal held in a vault helps reduce that burden. He stated that he believes gold could reach $8,000 per ounce by March. His prediction was not presented as investment advice. It was simply his belief, formed by observing the same economic signals that had driven so many others into the precious metals market. Conversations along the block were filled with speculation. Rumors circulated about who or what was responsible for the volatility. Some people blamed foreign governments. Others pointed to hedge funds that they believed were manipulating global markets for profit. Shop owners reported that customers from all backgrounds were either buying or selling. The motivations were varied. Some cited wars in Ukraine and the Middle East. Others expressed fears of economic chaos within the United States. Interestingly, cryptocurrency did not come up in these discussions. Despite the fact that digital currencies are often mentioned in the same breath as precious metals when the topic is alternative stores of value, they were absent from the conversations happening in the Diamond District this week. Silver, in particular, drew significant attention. A dealer named Bernie, who was calling out to people passing by in the cold, said demand for silver had jumped following 2 specific developments. Late last year, the United States government labeled silver a critical mineral. More recently, news emerged about a fast-charging silver carbon electric vehicle battery. These developments added a layer of industrial and technological significance to a metal that had already been attracting attention for traditional reasons. Bernie recalled a time when silver was priced at $19 per ounce. He said people laughed at him then. He said he saw the charts and understood what was coming. He listed a range of uses for silver, including applications in artificial intelligence systems, medicine, and weapons. According to Bernie, none of these technologies work without large amounts of silver. His comments reflected a broader narrative that has taken hold in certain corners of the investment world, a narrative that frames silver not just as a hedge against inflation, but as a critical component of modern technology. At a store called Benny's Jewelry, the manager, who identified himself as Yoni, offered a different perspective. He said rising prices had pushed regular buyers out of the market. Business was okay, he said, but it was not great. Gold was high, and not everyone could afford it. Lab-grown diamonds were now everywhere, creating competition in another segment of the business. Watch prices were rising. Everything, he said, carried risk. The strategy, according to Yoni, was to try to buy right, to make smart purchasing decisions in an environment where almost nothing felt certain. He spoke while handling a loop and answering phone calls, a multitasking routine that underscored the relentless pace of work even in a disrupted market. Back at Moses Jewelry, the mood had lifted somewhat by early afternoon on Thursday. Teenagers filled the store, their attention focused on gold bars displayed behind glass. Moses observed that these were insane times. Right now, he said, people wanted metal. His statement captured the essential tension of the week. Prices were swinging wildly, refineries were refusing to buy, dealers were uncertain about valuation, yet demand remained strong. The desire for tangible assets, for something that could be held and stored and sold later, persisted even as the market convulsed. The events in the Diamond District this week are not isolated. They reflect broader dynamics in global financial markets. Precious metals have always been sensitive to uncertainty. They respond to inflation data, to currency fluctuations, to geopolitical events, and to shifts in monetary policy. All of those factors were in play this week. The record highs on Wednesday were a product of months of accumulated anxiety. The crash on Thursday morning was a response to profit-taking and perhaps to algorithmic trading that accelerated the sell-off. The announcement on Friday regarding the Federal Reserve Chair added a new layer of uncertainty, and the market reacted accordingly. For the people who work in the Diamond District, the week was a reminder of how quickly conditions can change. These are individuals who deal in physical goods. They hold metal, they store it, they transport it, they negotiate over it face to face. In an age where so much of finance is conducted electronically, where trades happen in milliseconds and assets exist only as entries in a database, the Diamond District remains a place where commerce is tactile. That makes it a valuable barometer of market sentiment. When dealers on West 47th Street cannot price their inventory, it is a sign that something fundamental has shifted. When refineries stop buying, it is a signal that the normal mechanisms of the market are under strain. When teenagers with silver coins cannot find a buyer, it is evidence that the disruption has reached every level of the ecosystem. The week's events also raise questions about what comes next. Will prices stabilize? Will refineries resume buying? Will the Federal Reserve's new leadership bring clarity or further uncertainty? These are questions that cannot be answered with confidence at this moment. What is clear is that the precious metals market has entered a period of heightened volatility. The factors that drove silver and gold to record highs have not disappeared. Inflation remains a concern. Geopolitical tensions continue. Policy decisions in Washington are still unfolding. At the same time, the sharp sell-offs demonstrate that the market is capable of swift and severe corrections. The combination creates an environment in which both opportunity and risk are amplified. For now, the dealers in the Diamond District are navigating uncertainty as best they can. They are monitoring screens, fielding phone calls, and trying to make decisions in a market that refuses to stay still. The stores remain open, the phones keep ringing, the sidewalks are still crowded, but the ease and confidence that characterized the business just days ago have been replaced by caution and calculation. The metal is still there, sitting in display cases and locked safes. The question is what it is worth. And at this moment, that question does not have a simple answer.